Hello there, traders. Welcome to today's live stream. It is the 11th of March, Tuesday, the 11th of March, 2 p.m. GMT. Hope everybody is doing well today. We're going to be going over some charts as usual. I'm going to break down what I'm looking at in the markets. We're going to have a look at the recent data that just dropped in the US. We've just had JOLTS job openings. I'm going to finish off the uploading of that to the currency strength meter. We'll go over the currency strength meter as well, and we'll do some other stuff too. So as always, guys, welcome. I hope you're all doing well. If you are new to the channel, hello. My name is 𝖢𝖥𝖣yi, I'm Senior Market Analyst here at 𝖢𝖥𝖣yi Markets. So if you have any questions while we're going along, please feel free to drop any questions. If you have any charts that you want me to take a look at and have a little breakdown on, I can take a look at that too. I can break them down from fundamental as well as technical. So let me know what you guys are trading this week, what you're up to this week. I've just taken a small loss to start the week, so I'm going to cover that. We had a good sort of last week. I must say we talked a lot about particular markets and they performed pretty well in line with the currency strength meter. Talking sort of Aussie Swiss short, Aussie yen short, pound Aussie long, pound Kiwi long, euro Oz long, all those markets that were on the currency strength meter performed pretty well. I took a loss on oil. I'll show you that breakdown. I have set another alert because if it sets up again, I'm happy to short, but at the same time, I'll be looking to see if we get the right condition or not. So, welcome everybody. Who've we got in today? We've got Harmy. Welcome. Hope you're doing well. Royston, welcome back. Good to have you in. I hope you are doing well. Diego, is the US stocks going more than that? Is going down more? US stocks going more 10 to 15% down. Good question. Good question. That's something that we are going to discuss in today's stream. If we have a little look at the S&P 500, we're continuing that downward path at the moment. Now, what is surprising to me is that we've blown through the seasonal 10% or what it's 7% drop, what we used to have between February and March, and currently we are down 8.5% from the 15th of February where that seasonal pattern begins. So on the deepest sort of downside we've had is 7.04%. Now that kind of brings us into round about this area here where you can see this kind of horizontal line, and this was our seasonal drawdown essentially, which I'll go over in a bit. That's taken out COVID, okay, and we've surpassed that now. We've surpassed that. So I would say personally this move is becoming a little bit overextended now, but we're going to discuss that in a little bit more depth. We're going to go over the JOLTS job openings numbers. I'm just keeping an eye on oil on my other screen as well because I do like the potential short there, and I already was short, but I followed my risk management plan, and because price made a new high on the hourly chart, I took myself out of that trade. But we're now consolidating at a really interesting area. So if we get the setup again, I think we're going to go short again. So I'm going to keep an eye on that in the corner of my eye, up on the top screen. So if you keep seeing me kind of looking over there, that's because I'm doing that. Let's get into it though. I'm going to full screen today because I want you guys to be able to see what is going on. Who else have we got in there? We've got Tunji, Barry. Hello, welcome to you. Hope you're doing well, mate. Innocent, good afternoon to you as well. So let me full screen it a little bit. I'm going to edit that layout because I don't like how that particularly looks. Let me save that. Okay. There we go. Right. So let's go over the fundamentals of the market first, because it's super important to do that. Good afternoon, Guy. Hope you're well. I want us to keep on top of what's going on from a fundamental standpoint, and then we can build from that. Okay. It's always important to me to understand why we want to be involved with a market first, rather than, you know, looking to just find a trade. Okay. I don't believe in just staring at your charts, because you can make a trade out of anything, right? You can look at anything long enough and you'll see a trade set up. What we want is meaning behind that. We want to know that there are other people on our side too. So that's what we're going to be discussing today. Let's bring over the fundamentals. Wasn't a lot going on over Monday. We did have some data over the weekend though. We did get some data out of China, CPI and PPI coming in a little bit lower. Okay, that was beating those kind of forecasts there to the downside. We did get some data out of Japan, okay, and we also got some data out of Europe, especially Germany's industrial production month on month, which actually climbed 2%. So starting to see maybe a little bit of good stuff going on there for Germany. Trade balance was down to 16 billion, so that came in a little bit lower, but that is to be expected considering the situation going on in the market. Let's have a look at what's happened today though. So big thing that was coming up today, we had the CB leading index in the UK coming in at minus 0.3%, but JOLTS job openings coming in at 2 p.m. So about 7 minutes ago we had this. We had a 7.74 reading, which was better than the previous. Okay, so 7.65. We did get a revision though. We got revision down from 7.6 to 7.51. So beat forecasts, beat previous, and we saw JOLTS job openings increase to 7.74, which is a good thing, right? When you see this start to increase, it means that there are obviously more jobs available in the economy. What we've pretty much seen in line with inflation expectations is when inflation went higher, and we saw 2022 and 2001, that real burst higher of inflation, job openings went with that because there was a lot of demand in the market, right? So when there's a lot of demand, more jobs are available to people because we need to cover for that demand. As soon as that demand started to fall away, the need for jobs fell away as well. Starting to just kind of cushion here a little bit on the JOLTS job openings, just kind of hovering around a little bit. I think if we do see continuations and a decline down, that would still spell some further trouble ahead for the US economy. A couple of questions I can see coming through. Sorry, as a swing trader using fundamental analysis to take a trade, when should I check the fundamental? Because GDP and interest rate doesn't change daily or weekly. That's a fantastic question, Tunji. I do not necessarily check the fundamentals on a day-to-day basis. Obviously, I understand what's coming up, what's coming ahead. It's more to do with, for me, the expectations of a central bank doing something with their interest rates, right? And then if, let's say you go for a period where all central banks are just kind of holding interest rates, which we've been through for a while, it goes down to other factors. You know, GDP, for instance, is GDP increasing? How will that impact on employment? Is employment good? As in, like, is unemployment levels low? That means that we usually get a stronger economy as well. So I think checking fundamental analysis for me is more of like a day-to-day. Does it impact necessarily the way I trade, like right there and then? No, not unless it's something that is really significant. So I guess case in point was when you look at, when you think about Euro US dollar, right? Euro US dollar, I still feel could still have a little bit of legs to the downside. The market though has got almost, I think, overexcited over the possibility that this stimulus package that has come in essentially to increase defense and infrastructure in Europe, and throughout Europe, the market's almost, I think, over-egged that a little bit, because the German data still isn't fantastic. So those type of things, though, are things that are less predictable, right? So they're harder to trade on a day-to-day basis, but that does change your rhetoric slightly, because if Europe are going to see this huge stimulus coming into play, and this isn't something that's going to just be, oh, here's 800 billion euros, there you go. This is something that they then have to push throughout Europe and build that infrastructure. And infrastructure, we know, doesn't take 2 days to, build a building, build teams, build defense, X, Y, and Z. This is something that's going to be over a 10-year period. So that's going to create jobs within Europe, X, Y, and Z. So that's a big positive. But then you have to take a look at the other indicators as well. This is why I'm building out my little fundamental tracker as well. I haven't managed to change this up yet, because I had a conversation with a colleague of mine, Jordan, and we were talking about how we can, potentially build this out further by putting it into sectors. But this is what I like to do. I like to map out the fundamentals of an economy, and then I like to understand if they're what trajectory is that path on, right? And if you start to see essentially more red on the screen, it means that that currency is probably likely to be a little bit weaker. One big thing that I like to look at is the difference between 2-year yields and the current interest rate. The reason why I like to look at this is because the US 2-year bond yields react very aggressively, or are more reactive to interest rate situations within the market. So the bond market thinks that there's going to be a rate hike or a rate cut, right? Then you will see that reflected in bond yields. And at the moment, the difference between the US 2-year bond yields and the current US interest rate is 0.538. Now, that could come in and then say, well, does that mean the market is expecting 2 rate cuts this year? Potentially, because we usually see rate cuts coming in at 25 basis points each. If that starts to worsen, right? So let's say US 2-year yields go to 3%, and we see the difference between the interest rate and the 2-year yields go to 1.5%. That means there's going to be some significant changes within that market. And that also means that there's probably a good chance that that currency is going to weaken. Okay. So little things like that, you've got to try and build it's like building a puzzle, right? When you're using fundamental analysis, it's like building a puzzle. But ultimately, and this is where some people always go, what should you learn? Learn interest rates, because ultimately that's where it's going to come down to, right? Is there going to be a change in the interest rate? Who's going to be changing interest rates? That's why I'm pretty much a buyer of the Japanese yen this year, right? Because of the fact the Bank of Japan are one of the only central banks, especially out of the sort of G7, G10 currencies, that are looking to hike interest rates. So immediately you've got a central bank that is differing from, let's say, the US, who are cutting interest rates right now, or Switzerland, who are cutting interest rates pretty aggressively, or even New Zealand, right? So you've got differences there. And when you go and look at those charts, you will see that those charts are down. The yen is a strong currency at the moment. So I think that's a really great question, Tunji, to be honest. I hope I've kind of answered it there. I would say you've still got to monitor it on a week-to-week basis. If I'm going to put a number on it, because you have some indicators that do change on a week-to-week. So initial jobless claims, for instance, that is a weekly report that comes out, and that's something that I monitor on a week-to-week basis. We've just had JOLTS job openings, so I can now update that. So once these indicators come out, I can update them. So previous was revised down to 7.51. So I can come over here and say 7.51, okay, and that was a revision down. So I'm just going to mark that in red. Okay, and then I need to come to the forecasted section. Forecast was 7.65, 7.65, and we had a 7.74, wasn't it? 7.74. So that beats the previous. So basically you can see that we've had 0.09, so that's 90,000, right? I believe, if my math is correct. My math might be wrong there. So 7.74, so that was a positive number. Let's put that in blue. Okay, so I'll come over and I need to work out the strength meter reference right now, but I'm give that a +2 because it's beaten previous and beaten the forecasts. But yeah, you are right, you know, fundamental data doesn't change all that often, but it's good to keep on top of it and just keep your finger on the pulse is what I like to say. Good afternoon, Vincent. I hope you are well too. Good afternoon to you as well, Ratish. Innocent, I went long on gold today. So far it's doing well. Please, what's going to happen to pound US dollar? Well, we can go take a look at all those markets. Let's have a look at the currency strength meter. I'll come on to commitment of trader reports data very shortly because there is some very interesting data going on the COT reports, but let's have a look at what's going on here then from currency strength and weakness point of view. Here we have the currency strength meter, okay, and what it's basically telling me, it's giving me a place to focus week to week. So Europe, or the euro, sorry, has increased to +5, which means that it was the strongest currency of last week. It gained 6 places. The pound remains the same at +5, so no change on the pound. Aussie was one of the weaker currencies last week, losing places. Surprisingly, or not so surprisingly, if you follow the commitment of trader reports, New Zealand dollar has gained a little bit of ground. I'm actually keeping a very close eye on Kiwi yen right now because the yen has been at +7 for a very long time. And there are a couple of commitment of trader signals here that I really like. So we're going to have a look at those in a moment. Dollar weakened, CAD weakened as well. Thing is, a lot of currencies are in those kind of reversal situations now for me. So this is why I highlight them in yellow. You can see this kind of little key down here. Whenever it's highlighted in yellow, that means it's coming to a bit of a reversal zone, right? So anyway, coming from that, I create a little table from what I'm looking at this week, which is here, okay? So what I'm looking at from a bullish side of things is long Euro CAD, long Pound CAD. I'm looking for longs on Euro, Oz, Pound, Aussie. I'm looking for longs on, sorry, that dollar yen should be over here. That should be over there, sorry. Looking for longs on Euro, dollar, Pound, US dollar. And I'm looking for shorts, CAD Swiss, CAD yen, Aussie Swiss, dollar Swiss, and dollar yen is meant to actually be there. So let me just move that over. To not confuse anybody. So yes, lots to look at. Now, when looking at the conditions of those markets, a lot of markets are looking pretty good. Okay, so Euro US dollar is bullish. Innocent, you want to look at pound is bullish as well. Dollar yen bearish, dollar Swiss bearish. So looking for the continuations of those, to be honest. But am I looking to buy them right this second? No, but you know, they are markets that I'm interested in. Interested in selling Aussie Swiss. I did that last week and that turned out really well. Sold Aussie yen as well. Both trades worked out very well. Like the idea of continuing that. Less so on the Japanese yen because I'm going to show you why, but I'm going to write that down. But CAD Swiss, CAD yen alike. Euro Oz bullish, Euro CAD bullish. And then we've got Pound Aussie bullish, Pound CAD bullish as well. So that's my watch list going into this trading week. Let's go take a look at a few of those charts then. So let's not hold you back from what you like to see. You like to look at charts and have a little look at some areas of interest. So let's start off. We'll start off with euro dollar, and we'll go down from there. So obviously we had a very, very strong week last week. Now, typically after a strong week, I would have anticipated a week that then followed a little bit of downside, or at least some sideways movement. That doesn't seem to be the case at the moment. Price is continuing to drive higher here for euro dollar at the moment, which is quite interesting to see, especially because we're at, I would say, quite a decent resistance zone, being these highs that formed back in November. I would say that was quite a strong level where sellers were involved in the market. So seeing them back at this point, I would say that, you know, how would you get long at those areas? You know, because in my eyes, where would I put my stop losses? So, you know, again, where is the safe stop loss? It's down here, right? Below that swing low. Unless you're intraday trading, right? But as a swing trader, that is where I would say safe stop is. I don't think going long there is a good idea. Okay. I don't see that being a good idea. So I would like to see some kind of pullback. Honestly, I'd probably look for a daily pullback at least. That's where I'm kind of thinking about at the moment. So I don't want to short it either, although I feel like that could be a good place to get short from a value point of view. From a fundamental standpoint at the moment, the market is obviously still very buoyed by the stimulus that came out, plus the fact that you've got dollar data, which isn't good. So the dollar is still a weaker currency right now. So I don't want to short it, but I don't want to buy it here either. You know, maybe if we can get some kind of pullback down into maybe that kind of pause candle, that pause day, the low or something in and around there would be ideal to then look for longs for me. But I can't get long there because we're still technically in that primary phase, right? I want to look for when the secondary phase turns into a primary phase, right? At these moments here, these kind of points in the market, right, where the low forms. That's where I want to try and get involved. So I can't do that on that area. So I need to wait for some kind of pullback. Now, if we get lower, you know, if we can come back to like 1.06 without huge changes in the fundamentals, then these could be good areas to look to be a buyer from. But, you know, that would be what? 2.7%, 300 pip decline from there, 400 pip decline. That would take another sort of week that is kind of unprecedented. We haven't had a week like that since, well, the highest sort of move that we had, I think, was about 5 years ago. Well, yeah, 2020, right? So that makes a lot of sense. And I think if we're going to see a pullback that deep, I just don't see it. I don't see it happening right now. So I want to see like maybe a few days of pullback. Yes, we can probably go down to a lower time frame and have a look at something here, you know, maybe a stop loss, you know, which can be below this kind of 50 moving average or something. But I'd have to judge that at the time. I'd have to see what ATR is doing on the stop loss for that kind of move. Wait for pullback to the buy zone. Yeah. Would you put your stop below 1.0907? Or you put your stop loss below 1.0907? That's kind of where we're at now, right? I mean, I don't trade 5 minute, 1 minute time frames anymore. I'm very much a higher time frame trader. So I think two options for me. If we can pull back down into this kind of area here, form some kind of rejection and a change of trend on a lower time frame, you know, I'm happy to be involved there. If we get to here, even better. I think that, you know, anywhere where the safe stop is the best, which is down below this 1.0350, the closer I get to that, the happier I am to take along. But that would take a big move. So looking for a shallow pullback, maybe an extension up into the 112 if I'm really being honest about that. Cable is a little bit different because we've kind of broken and consolidated, whereas euros just kind of continue to push on. Pound hasn't really done that. We have had that sort of consolidation instead, which is something that, again, I would have expected. So at the moment, this 4-hour chart is showing price just kind of in a range. So again, if I want to be a buyer of a market, I don't want to be buying at highs. It doesn't make sense to do that because where's your safe stop, right? It's there. So that risk open here, I don't like that, especially when you've got 1.3 just above. I would much rather see price come down to this area here first. Then if we get some kind of change, I can put my stop loss bin below those lows there. At the moment, I don't like sort of where that is particularly at, right? Looking at sort of these swing highs here, I quite like that 128 handle. Something in around about that 128 or 120, 26.75, something like that. That to me looks like a good little area to get involved with the market, right? Somewhere in around those areas here. Okay. Looking to the upside, look at that 1.3. It's got a lot of price action going in around that 1.3 area. So when it comes to the pound's actually quite reactive to whole numbers. And, I always use whole number, quarter numbers, half numbers when doing analysis. So the market is quite reactive when it comes to the pound. It's almost like, I don't know if anybody's done a study with the 20 moving average and the pound, but the 20 moving average and the pound work really well together. As in, if you look across pound pairs and you put a 20 moving average on, you'll see that the market reacts really well to it. So that's something if you're ever interested in looking into. But cable, I still like to the upside as well. It's just, where do you get long, right? And for me, I'm not going to be going into a long position unless we kind of pull back. I will add an alert down at this range low because that makes sense to do that. So if I look at the 15-minute time frame, let's say price comes down into here and we get some kind of bounce, very similar to, price comes in, it forms a high, and then it breaks that high there. That would be a nice entry. Stop loss below the lows, targets up at the previous swing high. That's usually my sort of bag there. If you're going to try and sort of trade the range here, you can see we're breaking that low, so that would make sense to see price come down, maybe into that support. But at the same time, I don't want to sell this market. Sorry, I can see my alert going off. Oil is starting to breach lower again. I've got 2 minutes until that candle closes, so I'm just going to put my position size in, because I'm just looking at a potential. Just going to map it out. It's not closed yet, so I'm not doing anything until that market closes. And this is a 15-minute trade, so I would be looking to take only a 0.25% move on this. Right, so let me just do some sorting out of what that would look like. Okay, so position size around that. Okay, I'm going to wait on that. Let me go show you what I'm talking about on oil. So oil, I liked the idea of being short. It hasn't closed below the low though, so I'm not going to be entering that trade. Now, why am I interested in oil? Well, I've been interested in shorting oil since we kind of broke the 72.50 level, and price has been kind of pushing down towards that 65 low. Now, usually I wouldn't want to get short because we're so close to support, but when I looked at the sort of market in terms of where we're going in terms of risk, we saw obviously stock markets decline, things like that, and the stock markets were aggressively lower. Now, usually that also relates to oil, because oil is a risk asset, right? So usually when the market is performing well, oil performs well. When the market is performing poorly, oil can perform poorly as well. So I got short basically off of this move here, right? So looked at a potential breakout opportunity that was forming on the 4-hour chart. So we were pulling back, we were making higher highs, higher lows. We then changed conditions here. So yesterday I actually got short here, whoops, there, with my stop loss above the swing highs, because I was looking to target to see if we would kind of break and go down to the next leg. Again, I only put 0.25% risk on this because I knew that we were at these lows. So I didn't really want to push risk at that point. I'm not going to take a full 1% here because honestly, it's a silly thing to do. But I was looking for the 0.5%, as in, well, quarter percent. It's worth a punt on 0.25%, right? Because if it does follow through, I'm in the trade, plus I can add in on the way down potentially. So I got into this yesterday. Market punched down. I looked at this early this morning and was like, okay, it's not looking too bad. We then retraced throughout the rest of the day. I got out of this trade because I was looking at this trend line here, and I said to myself, well, if I break that trend line to the upside, you know, I think there's a good chance that this market could continue to trade higher. We did break it. I closed my position, and you know, I walked away with like a 0.1 something loss out of it, right? Which isn't, you know, it's not going to hurt. Looking at this now though, we're in that sort of retracement phase, right? You know, I'm looking at this as a very short-term trade. I'm looking at something very different. So I believe that the market is fractal, right? And what I mean by that is when you've got that sort of primary phase, secondary phase, primary phase, if it doesn't matter what time frame you're on, let's say it's a 4-hour, right? Then the 15-minute, 30-minute time frame is going to be doing sort of a downward trend on the primary phase, upward trend on the secondary phase, downward trend on the primary phase. I can prove that to you by going to highlighting that primary phase there on this 4-hour chart, go into a 15-minute, and you can see the market starts to form lower lows and lower highs, right? Super simple. When that condition changes, right, market goes into the secondary phase. Okay, so that's your primary phase, secondary phase. Are we going to go back into a 4-hour primary phase and trade down to that supporting low? That's my question, right? Is that a thing? Is that going to be something that happens, right? Now, what condition will I need to see? Well, this market is making higher highs and higher lows. What do I need to see? I need to see a close below the previous swing low. So I'm waiting here, and if I get a 15-minute bearish close here, I'm going to look to short oil, stop losses above the high there, and I'm going to look to try and target this swing low, and I am going to use 0.25%. Why? Because I'm trading on a 15-minute time frame. Okay, if I was on the daily chart and this was a daily swing and things like that, you know, I'd do a full 1%, but because I'm on the 15-minute time frame, I'm going to use 0.25%, because you're more likely to get stopped out on a 15-minute, right? You are more likely to get stopped out on a 15 minutes. So why? Because your stop loss is a lot smaller. Okay, it doesn't matter sort of necessarily where you are on the chart. If you trade in lower time frames, your stop loss is naturally smaller. So you want to be trading with lower risk. Okay, it's very easy for traders to get to a 15-minute, 5-minute chart, pile on 1% risk on every single trade. Next thing you know, you're 4 or 5% down because you've tried to chase the market. That's not what we're trying to do. We're trying to be here. We're trying to beat the market year to year, month to month, and we're trying to progress. Okay, that's what it's about. It's about staying in the game, right? A lot of traders do really well by going very aggressive with risk, but then can lose it all. Okay, I don't want to be that person. I want to be the consistent winner over and over again. So I'm going to look at this 15-minute here. So I've got, how long have we got left till the end of that candlestick? We've got 10 minutes to the end of that candlestick. I'll come back in 10 minutes. I've got it set up on my other screen. I've got my risk set up in there as well. So if we do achieve that close that I'm looking for, I'm going to look to go short on that one. Take profit is going to be around the quarter number, so 65.25 is what I'm going to be looking at personally. Okay, and by all means, guys, this is not any trading advice or anything like that. You do your own research. Trading on margin is very high risk. Okay, so please do your own research and due diligence before you do any trading activity within the market. Okay, so I'll see how that one pans out in about 10 minutes or so. Okay, now let me talk about a market that I'm really interested in, Kiwi yen. Okay, now this market is very, very interesting to me. I've got some messages. Sorry, guys. Afternoon, Bongo. Hope you're doing well. Afternoon as well, Kayvan. Welcome to the live stream. Hope you are well. If you're liking the content so far, guys, please feel free to hit that like button. It lets me know that you're enjoying the market. My goal here is to kind of get you thinking outside the box a little bit when it comes to your trading. You know, everything's not always about technical analysis. You know, it's about thinking about why you want to be in a market. You know, now looking at Kiwi yen, I'd like to get your thoughts on this. I'm thinking about Kiwi yen, but am I looking to go long or am I looking to go short? I'm going to let you answer that. I'm going to just take a sip of coffee while I do. Am I looking to go long or am I looking to go short Kiwi yen? Tunji, you're absolutely right. You are absolutely correct there. US oil is on a support level. On a swing trading chart, absolutely. I'm looking to take a very small advantage of that. Okay. Hello, Ibrahim as well. Ibrahim saying long. Looking to go long. Right, guys saying he would wait. I've made a coffee and it honestly, it's not my best job. It's not my best job with this coffee, I must admit. I don't think I frothed that properly. So we're looking at Kiwi yen. Right, let me break this down. So remember, always think about this method. Why? Conditions, strategy. Right? This is all I think about when I come to the markets. And I always try, let's put that in the corner over there. I always try and do this away from the charts. You know, why do you want to be into the market? Okay, why? And a lot of that comes from sentiment. Royston's putting in short based on yen strength. I like it. I like it. The answer right now actually is long. Now that may seem surprising, but I'm going to show you why. Now, Royston, you are right. Short based on yen strength. I do want to be short on a longer term outlook when it comes to Kiwi yen. I do want to be short on a longer term outlook. Okay. But I'm going to show you a potential of why this market could start to pull back a little bit. Now, I use the commitment of trader a lot in my trading. Okay. Now, if you're not familiar with the commitment of trader reports, they are a report that is collected by the CFTC, and what it shows you is positioning from hedge funds, positioning from commercials, so businesses that are using the currency markets to hedge global risk, and it shows you essentially what big speculators are doing in the market. Right, guys, got it there. Okay. Kiwi yen, what did you ask? I just asked if we were going long or short Kiwi yen. I'm on the sidelines, but I'll go long if a break of structure to long side. It's lost at some points on the currency strength. meter. Yeah, you're absolutely right. But I want to show you something here. This is something that I found really interesting. So what we've got here is the commitment of trader reports and the weekly updates, right? Now, the COT reports we only get on a Friday, okay? So it's collected on the Tuesday. We don't see the report until Friday. So we're a week behind the hedge funds, right? That's okay. Okay, in my book, that's okay, because hedge funds, when they're going big into a particular market, they're not necessarily, going to put all their contracts in at one go, because it would just flood the market. Everyone would see that, everyone would back it, and there would be no loser. And trading is a zero-sum game, right? Now, when we look at the Japanese yen, I'm going to show you something really interesting. So Japanese yen futures contracts here, okay? I'm going to highlight that zone there. From January 28th, 2025, we can see that hedge funds have been increasing their long positions, okay? This is net positions. Net positions is the difference between long and short contracts. So we were at minus 959, then we went to positive 18, okay? Positive 54, positive 60, positive 95, positive 133,651 contracts. That is a 52-week high, okay? That is also the largest level in history, okay? That has surpassed the previous 52-week high level, okay? So that is telling us that hedge funds are very aggressive buying Japanese yen, right? Now let's look at New Zealand, okay? What has been happening with the Kiwi? Well, we've actually seen the opposite. Negative 47,000, negative 49, 49.3, negative 52, negative 53, negative 55. That is a 52-week low, surpassing the 52-week low. So we've got two currencies on the opposite side of each other. Now, why is that important? So let's have a little look first at the trend capabilities that creates, okay? Because I often talk about the reversal setups that this can point to, but I'm also going to show you the trend. So since January 28th, we've seen hedge funds buy yen. We've seen them short New Zealand dollar. So technically, Kiwi yen from January 28th should have been bearish, okay? And we know that because we can see it on the chart. But what I'm going to do is just put it on here, okay? So that would be this week here. They've been bearish since then. Now you might think, well, okay, great, but how does that help me as a trend or as a trader, right? But if you notice that they were selling those markets, you've got lots of opportunity to sell in here, even as a day trader or a swing trader. For me personally, I would be looking for any of these pullbacks to sell, right? I would have been looking, selling here, selling around here, selling here, okay? Looking at the structure of the market. If you're an intraday trader, you could have been looking to sell short-term pullbacks, right? And that is a great thing to do. It would have been very profitable for you from January 27th. Now let's go back to the contracts here, okay? Why is it important that this is a 52-week high? Well, usually, let's just open the contracts up. I'm just going to dive into the charts, take off the commercials and small speculators. Usually, when we reach some kind of extreme in the market, price can fall away, okay? The price can reverse. A large part of that reason is profit taking, okay? Hedge funds have reached their max size, so they deleverage some of those positions. And if they are max long on the Japanese yen and they deleverage some of those positions, okay, what's that doing? It's selling the market, okay? That's what we could be seeing or witnessing here at the moment. And we discussed this last week in terms of the fact that we'd come into this kind of area of resistance, okay? On the weekly chart, this is a weekly chart, by the way. On a weekly chart, contracts were pushing higher, but they hadn't reached a significant milestone. This is a significant milestone, 133,651 contracts to the upside. So what this tells me is that, one, hedge funds are extremely long. 2, we're at a point where this could be that they need to pull out some of their positions to either go in again, right, which they could absolutely do, and I think they probably will, but they have to reposition. Okay, so what I'm looking at here is, could this be an area where we start to see Japanese yen come off? Let's look at the previous time we reached an extreme, right, which was here. If we look left from this point, we hadn't seen this extreme for a significant amount of time. High level of buying. What led to price was we had a decline. Okay, are we going to see a similar thing here? Right now, obviously it depends on a lot of global factors, and the commitment of traders suck at timing things, right, because you're a week behind on the data. But what we can look at is our structure points, you know, maybe up at this level here or this level here. Okay, if we start to see dollar yen rally by the end of this week, and I think there's a strong possibility that we are going to see some downside to the Japanese yen futures here, and that means that you could be looking to long Kiwi yen, dollar yen, CAD yen, things like that. If we go back further, okay, now what I'm going to do is just kind of open this up, and we're going to take a look at some of the times in history where hedge funds have been extremely long, right? This was hedge funds extremely long. That was a high in the market. You can see throughout this entire period here, hedge funds were pretty long in the market. Now we had this kind of slow build up, but once they kind of creeped over or crested over the sort of aggressive longs that were there in the past, we started to see that huge downside move. Again, that was a extreme. Looking backwards, what happened to price? It fell away. Here it was an extreme. What happened to price? It fell away. Okay, so whenever I start seeing something like this, it just flashes up a warning light to me and says, okay, maybe, just maybe, sorry guys, I'm just looking at oil, maybe, just maybe, we could start to see a little bit of a reversal in price. Now, don't get me wrong, I think yen is cheap. You know, if we look back in sort of history, okay, and where we're at with Japanese yen right now, I'd say it's still a fairly cheap currency, right? But at the same time, we've got things as well, like the Bank of Japan looking to hike interest rates and stuff like that. So I think if we were to get a correction, it would only be a short-term correction. That's why, Royston, I like your comment about, you know, you want to be buying Japanese yen. I do, I really do. But I want to see this kind of give back a little bit first, and then look to continue to buy the Japanese yen. So that can create short-term trading opportunities. Okay, now if we look at Kiwi as well and have a little look at what's going on over on Kiwi, okay, we're at the 2022 lows still. This is, you know, we talked about this coming into the end of last year about how contracts were at very aggressive levels, and New Zealand dollar hasn't really gone anywhere since, right? They're both still very weak. Fundamental picture in New Zealand isn't particularly great. So that's probably why we've seen this kind of sideways movement. You know, they're kind of being put down by the fact that we've got poor China data as well. But again, we've kind of reached that point. We've reached that point that it's a 52-week low. When we look back in history, hedge funds haven't been this short on New Zealand dollar ever. Okay, so what I'm looking for is, when we get those extremes, what happens with price? You know, here was a short extreme. Okay, we rallied only for a number of weeks. Then COVID happened. You know, that's 2020 COVID. Whole market went to crap really, before seeing that sort of recovery there. Here we had an extreme market pull back for a number of weeks. So are we going to see that again? Are we going to see a little bit of a push higher in New Zealand dollar? Okay, and if we do, can we try and take advantage of it? What I'm looking at is, can that be against the Japanese yen in the very near term, right? So when I look at Kiwi yen prices, market is heavily in a downtrend. I look at the weekly chart and there's some nice little areas. First of all, I quite like this area down here, down towards 81. That would be a really nice area to look for a bounce from, because you can see that we've got support all across here. Okay, so if we came down into there, I can see us having a little bounce up from that point. Second, I like where we're at now. We're at this kind of area where we had this spike low back in August. Market has also come back down, testing these lows here, and it's kind of struggling. It's kind of struggling at this point, okay? The only thing I think we've got going against us right now, obviously the overall predominant trend, but the second thing as well is the market is in a risk-off scenario. Japanese yen gets stronger in that. So if I'm going to go long on this market, I need some conditions to be met, right? This is what we always talk about. Why? Then we look at the conditions. Do we have the conditions here to buy this market yet? No. Okay, but I am keeping a very close eye on this move, okay, because if we fail at these lows, then this could be a double bottom pattern, right? And a double bottom pattern can lead to price push up towards these highs. If we break these highs, then we could be heading a little bit higher, perhaps into that 87 area. Okay, that's where I'm kind of looking to target for this type of move. So when I look at the 4-hour chart right now, okay, do we have a change of trend? No. Market is making lower lows and lower highs, right? What's fascinating though is we've come up into those previous highs and we've started to reject it, but we've closed very, very close to that high. So that to me is a good sign that we could be seeing a reversal. We're pushing back down here at the moment, okay, which is great because if I want to get long, down towards these kind of areas is going to be better for me from a risk reward perspective, because when I look to that daily chart, the target really needs to be up at these swing highs up here, okay? I'm looking to try and enter as close as I can to those areas here. Let's have a little look at what ATR is doing. That's stochastic. Where's ATR? So ATR is saying 50 pips, right? Let's go to the daily chart. Daily chart is 103 pips. So ATR at around that entry is somewhere around 82.47, I would say, around that kind of point. So let's have a look at that. 83.50, 85.50, and I'd say 82.47, something like that, right? That's what I'm going to be looking for. If I can get something down towards this level here on a lower time frame, I'll be looking for that potential reversal setup there. Now, because this is a reversal again, you got to understand the condition that you're in. The predominant trend is down. So do you want to take full 1% risk there? Absolutely not, okay? Because the conditions of the market are down. We're looking for a reversal setup, very, very short-term reversal setup. So I will be looking at 0.5% or below, okay? Because you've got to understand the condition of the market that you're in. All right. So using the commitment of trade reports, we did this last year. We had a really good opposing trade when it came to pound Swiss last year. We were looking at going short in and around this area here because we had the pound that were at significant long contracts, the highest level that we'd seen in a very long time. On the opposite side, we had the Swiss franc that had really heavy short contracts, and we were looking to see would those dynamics change. They did, and we had this downside in pound Swiss, and it was a very aggressive downside move. Granted, I had a poor trading performance on it because yes, I shorted here, yes, I shorted here, but I also shorted here, here, and here, and the market just kind of went sideways, so it ate back those profits that I gained. So looking at the conditions though here, they're very, very different to what we've seen on Kiwi yen, but at the same time, they've got the same sort of indication of what could happen. So whenever I see it, I want to try and see if there's a potential for us to gain an advantage from that. Now, another thing I like to do is, because we're trading Kiwi yen, right? So we're trading the New Zealand US dollar spot price versus dollar yen spot price, right? So what do I need to see happen? I need to see New Zealand dollar rally, and I need to see dollar yen rally to the upside. So another thing I like to do is have a little look at where those majors are sitting right now. When I look at Kiwi dollar, I'm kind of sitting above the daily 50 moving average in at a very, very minor level of support, okay, down into this point. All right, when you look at that there, okay, you can see that we've had resistance, support, and it's around a whole number as well, 57, which is nice. Okay, looking at dollar yen, we did break down that 149, so it's a little bit trickier when it comes to the yen outlook of this, because I would really have liked dollar yen to be like here and Kiwi dollar where it is, because it would make me think that we are going to see that nice little pushback to the upside. So yen's the tricky one, and I think yen's going to be the driver of this market in particular. So we need to see yen break trend first, and if it does break trend, then I think we're going to be on for that upside move, in particular on Kiwi yen. So hopefully that made sense, guys. Kiwi is currently creating a double bottom. Maybe it can reverse to the upside. Yeah, that's my thoughts. I think Kiwi will go up when China provides some stimulus to the economy. Yeah, I think we're going to be. I don't know when that's going to happen though, right, guy? That could take a while. I mean, some of the China indicators are starting to do well, right? So if we look at copper, for instance, copper broke out of this long-term trend line here and is now pushing back to the upside. Usually when copper does well, it's a sign that there is, good things going on in the economy, especially from a China point of view, because China are a big user of copper. So when you start to see things like that, that tends to be a decent sign. If we go take a look at what's happening on the Hong Kong index as well, the Hang Seng, the Hong Kong 50 index, starting to see that bullish move. It wasn't too long ago where we were down at these kind of really low levels here, and since then the market has pushed quite aggressively higher. So there are some kind of things going on. Maybe this was just because it was cheap, I don't know, but when you kind of look at sort of certain indicators that do relate to what's going on in China, then there are a few things that are starting to kind of bubble away a little bit. The one being the copper move as well. When you look at China's 10-year yields, they are aggressively to the downside, but we are starting to see some life coming back into it as well. I mean, look at that, craziness in there. And when you look at the dollar versus the Chinese yuan, we're up at this level here. Okay, now when we've been at this level in the past, we've seen nice little pulls away from that. Now that is one of my favorite trading patterns ever, which could lead to dollar breaking higher. But I think at the moment, if we do see a rejection here, that's things like long euro dollar, long pound dollar, long Aussie US dollar. Usually when you start to see emerging markets performing better, I mean, it's hard to say that China, the Chinese yuan is a emerging market currency. It's just classed as that, but China has the second largest economy in the world. So whether we can continue to say that or not is probably up for some kind of debate somewhere. But at the same time, when you see emerging market currencies do well, you're looking at things like dollar MEX, dollar CNH, when they start to do well, usually the US dollar performs pretty poorly. So there are some factors starting to kind of build together there for that type of move. Okay, now let's go back to the COT reports. I haven't actually dove too much into them. I just saw these here and thought that was quite interesting. Brazilian real as well. Very aggressive long on Brazilian real right now. I don't trade the Brazilian real, but that is something that is quite interesting to see. All right. Last time we were up here, we saw that downside move coming into the market. So, very interesting there. Let's have a little look across the list. Let's go to the full list and see if there's anything that's really kind of catching our eye. When I look at metals, we are still seeing sort of an increase over here. Starting to see a little bit of a slowdown in it, but still kind of high when you look at it from silver's point of view. Hedge funds are still buying silver. My silver trade last week didn't perform as well as I would have liked it to. I was long silver last week, ended up moving my stop loss up underneath this low before non-farm payrolls data came out, and then non-farm payrolls came out, took me out on my stop loss. Pushback since prices has kind of rallied to my first target, which was around about that $33 area, and silver looks to be fairly bullish right now. I like silver longs, to be honest. I like gold longs as well. I think they're good to kind of be on at the moment. I'm just looking to see if I can catch another move now. I prefer to trade silver because of where the gold silver ratio is. It's just my preference. If we just pop the silver chart on here and add it to compare, you'll see that when we start to see the gold silver ratio at high levels, the market tends to go and favor silver instead of gold. And this was 2020 where gold silver ratio was very high. You started to see that come off. It led to a very strong rally in silver. The last time it got pretty high, we saw a strong rally in silver here as well, strong rally in silver. We're back at that point. So using this correlation between the gold silver ratio and silver prices right now, I think that we're in the midst of a potential strong rally on silver, especially if we do see this come down from those high 90s down into the let me just change that, put that on the new scale. There we go. Regular. Being in the high 90s here can obviously give that opportunity for a nice little bullish leg on silver, and that's something I want to try and take advantage of. So I like silver upside. I in particular like it up towards that kind of $35 area, $35.50, and that's why I'm trying to look for continuations long into that market. And unfortunately for me, got stopped out last week. But I mean, look at the conditions of the market, right? This is exactly what I talk about. Daily chart was technically in that sort of secondary phase, right? That is the secondary phase in this bullish upward trend. Okay, didn't break and give me two closes below the low, so technically it's still a secondary phase for me. As soon as that condition changes on a lower time frame, that's the time to get long, and that's exactly what I did. If you go down to the hourly time frame, I ended up taking a long position on this market on a break of trend. Okay, ended up buying in around this level here. Market moved really nicely to the upside. I moved my stop loss below that swing low. I did say that I was going to move it only if we closed above that high, but because of the high impact data, I just moved my stop loss up. I got taken out. Market has continued to drive higher there. But yeah, I really like this silver long opportunity, and I think this is something I want to try and continue to take advantage of if I can, if we can get that continuation to the upside there. So any kind of daily pullbacks, I'm going to be looking at opportunities to be on those markets. Now, when we look at the stock market, I mean, look at that. S&P still going down today. NASDAQ, Dow breaking through as well. Russell continuing to push lower. Even other markets now, FTSE, DAX. And I mean, I can see why the FTSE and DAX are falling as well. They do a lot of business with America, and a lot of their profits from companies within the DAX and the FTSE come from America. So if America slows down as well, then the FTSE and the DAX will also likely feel the pressure of this. The DAX probably been a little bit more held up because of the fact that we've had that big defense stimulus coming through in the EU. So the DAX is probably a little bit more set up for that, maybe looking towards sort of like the Euro Stoxx 50 or something like that. But global markets really suffering at the moment. Look at the FTSE, the S&P 500. Now, we did discuss last week, that I think Eddie, when Eddie was in here, I don't know whether Eddie's in here today, but Eddie pointed out last week that there's actually a really strong seasonal pattern from February until March. And he was absolutely right. Between the 15th of February and I think it was the 23rd of March, stock markets are usually bearish. Okay. Now, we had looked at the max drawdown. We took COVID out of it, but the max drawdown was 7.04%. That's here, okay, from that specific date. So we are well below the average now, well below the average. You know, when you look at sort of indicators as well, when it comes to sort of things like your stochastics and your RSI, coming into those oversold conditions as well now, and kind of staying in those oversold conditions. So this is looking like it's a bit of a deeper situation rather than it just being a, you know, quote unquote correction within the markets. You know, when I look at sort of corrections in the past, they've been a matter of a kind of a couple of weeks. When you talk about, you know, little corrections within the markets, this has been going on now for 4 weeks. It's been a significant move. If we get a close below the 50 weekly average, there could be quite significant. One thing that stock market traders look at a lot is the daily 200 moving average, and look at that break and close now below the daily 200 moving average. You know, so I don't think investors will get confidence unless we get back above that, if I'm honest. If we look at what happened in, you know, 2022, we had that breakdown of it. We then had the crossover, and we went into a little bit of a bearish year until sort of we had the crossover here in March of 2023, and we pushed higher. There was a couple of instances where it nearly came back again in October and November of 2023, but price since then continued to sort of drive back to the upside. So it's going to be an interesting one. See if we can kind of recover from this. There's been a lot of talk from, you know, the president talking about, you know, short-term pain, long-term gain, in terms of we're going to have to suffer a little bit in order to go forward. So I think that's quite an interesting dynamic right now. So we'll see. We'll see if this correction continues. I think what history tells us, though, is that with it, you know, look at that. I mean, I know I'm not on the futures there. Markets really tend to just go up, right? So this is the futures market from 1997. So yeah, I mean, I would love a deeper correction. I think if we started to see valuations down towards the sort of in the 4,000s, I think that's going to be very, very significant to global risk in the market. You know, one thing that I'm really keeping my eye on at the moment is the volatility index. Okay, up a significant amount at the moment. Let me just go to the CFD VIX price, up at 28.38 right now. And you know, usually when we're above 20, that's pretty bad for stocks. What we tend to see are these like sharp moves above 20, right? These really kind of sharp moves. We're not having that at the moment. We've got this kind of slow grind up, and I think that is showing you the fear that is within the markets right now. So, I mean, if we push into the 30s, push into the 40s, it's going to be quite a deep correction. When looking back in sort of history, when we look at sort of Donald Trump's reign, when he was imposing tariffs and things like that, you know, we were susceptible to a few volatility spikes. You know, this was 2015, 2016, where we had those kind of moves in the past. I would be interested to look at that, actually. Let me bring up, I'm going to bring up something here. Let's have a look at our seasonal stuff. Yeah, this was that seasonal kind of play in there. I just wanted to bring on, I wanted to compare 2016. We kind of had the opposite in 2016. It started off pretty bearish in 2016, and then we had the little rally up. Let's look at 2018. very similar. So look, post-election years. There's not a huge correlation there on post-election years. No. But at the moment, look, where we had that kind of top in the market at the moment, it's very, very close to what's happened with our 10-year average. So, you know, look at that nice little sort of downward move there. Expected to end around the 23rd of March. So maybe we've got another week or so of downside. When we looked at sort of what was going on here, when the max drop was 7.04%, I know that says 33%, but that's COVID. So that is a little bit of an outlier in the market. If we went up to this little thing here and just clicked the bug out of it, you'll see that changes quite dramatically from that point, which is that little COVID bug. So maybe it's more like the 8th or 9th of March then. .4% drop that we've had so far this year. So we'll keep an eye on it. I'll leave the little COVID bug in there because we might be kind of following a very similar sort of fear within the market at the moment. So we'll keep an eye on that. Right then, guys, we've been going for about an hour and a little bit. Any questions? Any questions? Anything that you want me to take a look at? If not, I will leave it there. But yeah, I mean, look at that. Euro dollar. Wow. So pretty much for me on the watch list this week, you know, looking across the board, I do still like the idea of trading a few of these. You know, keeping my eye on a couple of them. CAD Swiss, you know, CAD Yen. Swiss has been really strong at the moment. This was my trade last week on Aussie Swiss. Nice little sort of break in that trend there on the hourly. But I need to see some kind of pullback again, you know, on the daily chart. Give me a few days of pullback and I'd be potentially involved there. Aussie Yen as well. CAD Swiss. CAD Swiss just went. I wasn't confident in trading CAD Swiss short, but look at that move in the end. Nice little couple of pullbacks on the day. Break of that trend. Market continued to trade lower. Euro Aussie also performed pretty well, but we still haven't had a pullback on that. Pound Aussie was the really good one last week. Look at that little sort of 3-day pullback. And then again, break of that trend. Market just, you know, really went for it to the upside. So still starting to see pound stronger than the likes of the Australian dollar and whatnot. Nasdaq trying to get a little bit of something back today. See that little consolidation over here would be a good area of volume. Good area of volume there. Let's have a look at it from. This is delayed data, by the way, 10 minutes delayed, so that's why you're seeing it not look the same. Okay, I'm going to leave it there then, guys. You're welcome, Rago. I hope you enjoyed. If you did enjoy it, please leave a thumbs up. I'd really appreciate that. I hope you did enjoy it, and if you are new and you enjoyed it, hit that subscribe button. I will be back again on Thursday, and I'll appreciate it if you could join me then as well, same time, 2 p.m. GMT. I hope you have a great rest of your trading day, and I hope you have a successful week. So thank you very much, and I will speak to you very, very soon. Cheers, guys.